In this video, we are going to talk about dividend stocks for passive income. So before starting this video, please like this video and subscribe to this channel for our future updates. In today's unstable market, do you want to find a way to earn money while maintaining your peace of mind? Even stocks with a strong track record of stability and dividend growth have been caught up in the recent sell-off, despite the fact that growth in technology sectors have been struck especially hard by the broader market's decline. The recent bad market has caused many prospective dividend payers to trade at levels that are far lower than their previous highs, providing investors with a once-in-a-lifetime opportunity to increase their passive income. Today we are going to look at firms that have steady operations, growing dividends, and low payout ratios, and we are going to investigate the reason why purchasing these stocks today could help you sleep easily at night. Number 1. FedEx. FedEx, a global transportation powerhouse, has seen its share price grow by about 20% over the course of the past 2 weeks. This increase comes on the heels of the company's announcement of a dividend increase of 53%, as well as a well-received earnings report for the fourth quarter. FedEx's future dividend yield is expected to increase to approximately 2%, with the recent increase in the quarterly dividend to $1.15 per share. In addition, the payout ratio for the company is only 15%, so shareholders can rest comfortable that FedEx can easily support any dividend increase. This is especially important considering the fact that earnings per share are still growing. FedEx reported an increase in revenue of 8% year over year for the fourth quarter of its fiscal year 2022, while also reporting an increase in adjusted earnings per share of 37% over the same period of time. Even better, management forecasts that adjusted earnings per share would be between $22.5 and $24.5 for the fiscal year 2023, which would represent an increase of around 14% compared to 2022. The optimistic forecast for the company's finances has prompted management to announce that they want to buy back $1.5 billion worth of their own shares over the course of the next 2 quarters, after which they will still have $2.6 billion left on their repurchase authorization. In the past 10 years, FedEx has cut the number of its outstanding shares by about 20%, which has contributed to the company's impressive earnings per share increase for shareholders. FedEx appears to be in an ideal position to continue its long and successful tradition of returning cash to shareholders, as it is anticipated that worldwide e-commerce sales would increase by a factor of 50 over the course of the next 4 years. Number 2. Sherwin-Williams. Sherwin-Williams is the most well-known brand name when it comes to anything and everything that has to do with painting. The value of its shares has dropped by around 1/3 over the course of the past 6 months, which is a reduction that is unusual to witness from such a reliable corporation. This decrease is a direct result of substantial supply chain challenges that have arisen over the past few quarters about the availability of raw materials. Sherwin-Williams had its adjusted earnings per share drop by 22% year over year when it reported its earnings for the first quarter of 2022, despite registering sales increase of 7% over the same time period. This drop in earnings should be transitory and may present an exciting entry point for investors who are interested in expanding their passive income. While this reduction in earnings was unexpected, it should be temporary. Sherwin-Williams continues to trade at its lowest valuation since the beginning of 2021, despite the fact that the earnings component of its price-to-earnings ratio has decreased. In addition, the corporation has grown the amount of money it pays out as dividends for the past 24 years in a row, while at the same time reducing the number of shares outstanding. The dividend yield is just slightly higher than 1% at the moment. Sherwin-Williams is able to explain why it has generated a total return of about 500% over the course of the last decade through a variety of factors, including continually expanding share count, an increasing dividend, and a dropping share count. Sherwin-Williams is an exceptional investment to take into consideration if you are looking to develop a new source of passive income. These incredible historical returns, stable underlying operations, and the possibility for further cash returns to shareholders make Sherwin-Williams an outstanding choice. Number 3. Stanley Black & Decker. Stanley Black & Decker might be considered the Sherwin-Williams of the tool industry due to the tremendous brand power it possesses in the areas of industrial tools, power tools, hand tools, and outdoor equipment. Stanley Black & Decker, much like the well-known paint manufacturer, has been dealing with its fair share of supply chain problems, as well as rapidly increasing prices for both commodities and transportation. The company's net income dropped by 64% during the first quarter of 2022, despite the fact that the company's revenues increased by 20% during the same time period. This may be one of the reasons why the stock has dropped by 40% over the course of the last 6 months. Nevertheless, management anticipates $10 in earnings per share and a $1 billion to $1.5 billion in free cash flow for 2022, despite the escalating expenses of transportation as well as growing prices for lithium, nickel, and steel. The company anticipates that it will be able to restore its margins by the end of 2023 and continue its top-line expansion through fresh outdoor equipment acquisitions. This is despite the fact that the shares trade at a low price. Taking everything into consideration, Stanley Black & Decker may not be an opportunity for investors to quickly double their money, but the company has an impressive track record of dividend increases and it has a high earnings yield of nearly 8%. So it appears to be an excellent opportunity for investors right now. Number 4, PepsiCo. You would have to go all the way back to 1972 to find a year in which PepsiCo did not increase its dividend payment to shareholders. The fact that the company has increased its dividend payments annually for the past half-century places it in the elite company of the dividend kings. In addition, it sends a clear message to investors that this business will not disappoint them in terms of the passive income it provides. The most recent results for Pepsi demonstrate how the company has been able to continue paying investors a growing dividend despite ups and downs in the economy. Even when compared to the booming results achieved the previous year, organic revenue has increased by 13% in the first half of 2022. Pepsi is expanding its market share in high-demand product categories such as energy drinks, sparkling beverages, and snack foods. There is no denying that Pepsi's profit margin has shrunk as a direct result of inflation and rising prices. Nevertheless, the corporation is still making larger profits and producing a plentiful amount of cash. These resources are providing cash for additional investments into the company, which is creating the framework for more rapid expansion. They are also supporting Pepsi's intentions to offer as much as $8 billion in cash returns to shareholders in 2022 alone, and they are backing Pepsi's strategies to deliver these returns. Number 5, McDonald's. The stock of McDonald's has been performing exceptionally well so far in 2022. The multinational fast food chain established a new benchmark for profitability with its most recent quarterly report, which revealed that it converted an astounding 43% of sales into operational profits. Because inflation is rising at a faster rate, investors are preparing themselves for potentially more negative news about profitability. In recent weeks, McDonald's most likely had to pay a great deal more for food imports, labor, and transportation, and the combined effects of these variables may have a negative impact on profitability when the company reports results for the second quarter on July 26th. On the other hand, there are very few businesses that are in a better position than the burger giant to capitalize on the current climate of consumer spending. Its value and premium options enable it to cater to a diverse group of customers who enjoy eating fast food. At a time when customers are gravitating towards on-the-go food and drink options, the establishment's stellar drive-through service provides it with a significant advantage over its competitors. What do you think of our video? Let us know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks so much for watching. Take care.